A financial crisis begins with bubbles, investment bubbles. But what are the factors that cause investment bubbles and what happens when they burst? A booming stock exchange, stability of local currency, a growing real estate market, or the unattractiveness of investment options in other countries? Combinations of these factors can entice foreign investors to place their bets in the economy of a country. Therefore, in addition to local investors, foreign investors, particularly speculative investors or hot monies, are attracted to investing in the country and start buying stocks. However, in order to invest in a country, these foreign investors must buy the local currency. For example, an investor from the United States would have to use their dollars to buy local currency of the country in which they want to invest. This rise in investments from foreign sources further increases the demand for local stocks and obviously their prices. More important, this is accompanied by an increase in the value of the country's currency relative to other foreign currencies, which has a more pervasive effect on the economy. As more investors are attracted to invest in the country, a state of irrational exuberance sets in, where investors believe that demand will continue to rise and that investments will continue to increase in profits. This can lead to a rush of investors eager to cash in on the perceived value of the investment opportunities in the country, and the boom continues, even as the prices of stocks outstrip the fundamental values of the companies behind these shares of stock. An investment bubble occurs. All of this is fine as long as the country's economy continues to grow, but certain factors can cause these bubbles to burst. Political conflict in the country, evidence of persistent fiscal mismanagement, for example, budget deficits and resulting national debt that seem to grow through the years, and the emergence of better investment opportunities in other parts of the world. A combination of these factors can trigger a sudden departure of foreign investors. As foreign investors begin to move out, they sell or liquidate their stocks and collect local currency, which they convert to a foreign currency, thus increasing the demand for foreign currency and weakening the value of the local currency. Local investors may follow suit and begin to sell or liquidate their stocks. Some may convert a portion of their local currency to foreign currency and invest in a safe haven. This is called capital flight and can further exacerbate the foreign exchange situation in the country. In an attempt to avert a crisis, the country's banking authorities buy local currency to protect its value. However, for developing countries, the reserve of foreign currencies, which is used to buy their own currency, is usually small relative to the reserves of foreign investors or hot monies. As the crisis unfolds, speculative investors may view neighboring or related countries as contaminated and equally risky and begin to pull out. This is called a contagion. The bursting of investment bubbles result in reduced value of a country's currency, draining its foreign currency reserves, frightening away investors, and more important, lenders, and impeding the country's ability to service its foreign obligations. A financial crisis sets in.